Good morning, ladies and gents, clients, future clients, and to the odd peer manager dialing in, as Zandberg Jansen would have said in his 1980s rugby forum on SAIK, Môre ou grote. Welcome. We hope you find snippets of interest and profound insight in today's quarterly report back by the Prescient Multi-Asset team. I'm Meyer Kutsia. Today's webinar will look into the resurgence of COVID, touch on the US elections, and then delve deeper into global equities, inflation, and low interest rates, all from the perspective of a systematic, big data-driven investment approach. But first, afford me a few minutes to remind us of the investment case for the Prescient Balance Fund. I'm sure we all agree that within a client's investment analysis and planning process, asset allocation is the key driver of potential success. It is absolutely critical to get the decision right on whether the client, for example, goes offshore or stay local, invest in alternative or traditional assets, invest in income, balanced or equity funds, etc. Once the decision has been agreed that a balanced fund is the right choice, the right balanced fund needs to be identified from literally hundreds of choices and thousands of blended permutations. The astute investor should be able to construct a portfolio for his client that delivers above average returns consistently. But we know in reality it's not easy. The Prescient Balance Fund was designed to deliver just that, outperform the other balance funds in the SA market with some form of predictability. The fund should never be bottom and it should never shoot out the lights over the shorter term. Incidentally, there's an old Chinese proverb saying that states, those who shoot out the lights end up in darkness. Okay, it's not really a Chinese wisdom, but I thought that it illustrates the link between risk and return quite effectively. But let's fall back on our mantra of systematic evidence-based investing and review the last 6+ years of the Prescient Balance Fund's history. In these slides, we'll look at rolling return periods versus all the funds in the CISA multi-asset high equity sector. I'm sure you're familiar with these charts as we show them all the time, frankly, just because they're true. Okay, rolling 1-year periods. The blue line depicts the rolling 1-year period return of the Prescient Balance Fund. And you'll notice that most often it's above average. It's never bottom quartile. And this is exactly our aim. If you go to 3-year periods, you'll notice that the wonder of compounding above average returns comes through strongly in a consistent profile that end up in the top quartile. In fact, if we look at the dispersion of returns over various periods, you'll notice that over 1-year periods, the fund has been above average 90% of the time and only 10% of the time below average. But this results in a profile that is top quartile 100% of the time over rolling 3 years and rolling 5 years. And we at Prescient are confident that this is the trend that will prevail in years to come. You might ask the process behind that. Well, it's very simple. We don't debate whether a 4x4 or a sports car is the best vehicle. We would prefer a fast, all-wheel drive sports utility. Likewise, we don't debate whether passive or active management is better. We like to take the best of both and combine their key attributes in one product. So what does that mean? For my passive product, the key attributes are low fees, low transaction costs, low tracking error. From active product, the attributes are the potential of alpha, which we deliver through a portable alpha process. Efficient allocation of capital, which we deliver through a detailed strategic asset allocation process. And capturing market dislocations, which we deliver through a robust and detailed tactical asset allocation process. Please send in questions, and remember, there are no silly questions, thus silly answers. Well, at this merry stage, I'll hand over to Bastian, who's head of our asset allocation and research at Prescient, and Rupert, who's portfolio manager in the multi-asset team, to share their insights and passion about our view of things through systematic glasses. Over to you, gents.
Thank you, Meyer. And first of all, also thanks to everybody in the audience for giving us the time and the opportunity to present our views, our outlook, and also our current positioning. We know Time is very valuable these days. So yeah, we appreciate if you can give us those 45 minutes. So we're going to start with a global macro story. If we speak about global macroeconomics, we have to speak about COVID. So we very often say actively that we are no virus experts, and we don't deem ourselves to always understand the medical side of things. But what we do think we do understand is the economics behind the COVID-19, and especially also the data which is driving markets. So we want to start with this slide, which is just some statistics. Basically, it's a response tracker, so basically a stringency index, which is derived by the University of Oxford, and we are always comparing South Africa in a global space, and for that instance, we're comparing South Africa here to the United States. So the blue line would basically be South Africa, and the red line would be the States, and the y-axis just shows how severe a lockdown would be. And in South Africa, you can see that we started the lockdown quite late. That might sound surprising because we were quite quickly to implement a hard lockdown. But remember that the virus basically traveled from China first to Europe, then to the States, and only a little bit later to South Africa. So what you can see that once we implemented the lockdown, we went into a very, very hard lockdown quickly, which is the blue line going up all the way to the 90th percentile of this ranking. So actually a much harsher lockdown than what we've seen in the States. Well, that's what we're highlighting in this red shaded area. As of recent already, as you know, we have restricted, we've basically released some of the restrictions to get economic activity up and running again. And so we have to now assess what that means in terms of the spread of the virus. So from a humanitarian point of view, the hard lockdown Chile was good. From a technical point of view, to avoid the spread. However, obviously there's severe economic damage done. So we have to observe how our economic recovery will compare to the United States, but also how the spread of the virus will compare over the next couple of weeks. So what you can see here is basically the infection growth rate. So this is daily new infections per 1 million people. So we're basically making South Africa comparable to the United States again. And what you can see is that this harsh lockdown helped us to avoid an early spread. We then, after we relaxed, saw a spike, and we are now basically back to quite low levels. However, we do not know yet whether we are through the worst, because in other economies like the United States or also in Europe, we are seeing a second wave, which is very different to the first wave in the way that we have less deaths and less hospitalizations, but we do have more infections even. So for South Africa, we have to be on the lookout. We are hoping, and I think hope is the right word, for a positive outcome, but we certainly don't have enough data yet to be certain that we are through the worst. So let's look at another chart from Google Analytics. So what we're looking at here is basically workplace activities, or this is basically Google tracking us where we are moving around. And yes, Google is able to do that nowadays, if you like it or not. And what you can see is that since the implementation of the hard lockdown, workplace activity in South Africa has fallen off a cliff, so dropped much sharper than in the United States. But then with restrictions being relieved, we also have quite a bit of a recovery. What is important for us is the 30% gap, which we are seeing at the top right of this chart. So we are still not back to full economic activity, or let's call it full back to workplace activity. And we do think this is a reflection of the new normal, that there are still quite a lot of people working from home, and we will have to find out and see in the data if this is basically a good trend, because it obviously clearly also creates opportunity, or if this is just a reflection of us not being close to going back to full economic activity anytime soon. So before I hand over to Rupert to cover the individual asset classes views in our systematic process, we want to just also look at some data from the Johns Hopkins University, just basically tracking how is the spread of the virus evolving globally. The bigger the circle, the more active cases we have had. You can see at South Africa, we had quite a few cases especially if you compare us against other countries in Africa. However, the circle is blue, which is still good news. So numbers are still coming down. What are the new problem areas? Well, obviously in India, there's a lot of COVID-19, and in the States, those are the two countries basically leading the stats. However, in both instances, the virus is on retreat, which is good news. New areas of new problematic areas would be, again, mostly in the emerging market space, which is Russia, Brazil, or Mexico, where we have quite a few cases and they are still on the rise. And especially Europe, unfortunately. So Europe has, other than Italy, actually managed to get through the first wave quite well. However, they are struggling quite badly at the moment with the second wave. So how does all of this translate into asset class views? Rupert is going to cover that just now. Before we go there, we also want to speak about one other event other than COVID, because we speak about COVID a lot already, and it is just very important to understand the economics behind COVID. But we want to also speak about the US election. It's just a month away, not even a month. So yeah, that will obviously also heavily drive markets. Just a quick overview on where we see polling and where we see betting odds. Betting odds historically actually a better predictor than the polling. In both instances, Biden is on the lead, not a very wide margin, but the margin is actually wider than it appears, because for those polls to basically swing all the way towards a Trump victory, that is something which is actually almost quite unlikely. We also like to look as what we call more like a holistic approach at the bottom, which is basically a simple scoring model which the New York Times uses very successfully. They've predicted basically the last couple of elections rightly. So it's basically a scoring model between Trump and Biden, where they give a tick to either the current president or the challenger. And on that scale, Biden would once again win the race, although it's a little bit closer. What I find interesting on the right-hand side of the scale, you can see that Biden gets a point because the current president is not deemed as charismatic. However, Trump gets a point because the challenger, Joe Biden, is also not very charismatic. So that's probably the situation which we're looking at. So if we see a Biden victory, what would it mean? It would most likely mean that politically the environment is going to be more stable. However, it's most likely not going to be good news for the market, because we will be facing a lot of tax hikes. We have presented on the corporate tax hikes before. That will be the biggest challenge, especially for equities. So it's going to be interesting to watch. What we can say with certainty, though, is that there will be a lot of volatility, and there will be opportunities arising from this. So we will rely on our robust process to cut through the noise and make sure that we basically get the calls right. Okay, so that's a bigger picture. I'm going to hand over to Rupert right now to drill into the individual asset classes and take you through our current position.
Thanks, Bastian, and thanks again all for joining us. So tying in with those two themes of COVID-19 and the trends that we're seeing within that infection, as well as US elections, we thought it would be appropriate to go into global equities, in particular into US equities, to see whether there is indeed a new bull market, which seems to have been the trend over the last 6 or so months, or whether that's smoke and mirrors, essentially, and whether the economic growth is just lackluster and can't support that trend. So looking as an overview into US equities, what we see at the moment in our scoring models is basically a hung vote. So we're seeing negative valuations, we're seeing a negative on balance economic picture, but what we're seeing is a positive financial conditions. So that comes via stimulus from the US Fed, as well as market perceptions of risk. And then we've got sentiment, which is pretty strong positive within the United States. So it's a bit of a balanced view. What we see as an interesting outlook going forward is the valuation cases most likely won't change unless there's significant growth to underpin those. The economic cases will probably remain mixed. The financial conditions, on the other hand, if there was to be an increase in some sort of a negative volatility event, tend to blow out quite quickly. Those are the credit spreads, funding pressure, and cross-currency basis. And then on the sentiment side, it remains to be seen what the US public, as well as US corporates, think or make of the potential for a Biden victory, or in the extreme left-tail event of a Trump victory. Digging a bit deeper into those, what we've seen recently, you'll see on the far right, there was an extreme increase in credit spreads, which is one of the perceptions of market risk. That was during the COVID-19 sell-off. It was a reasonably good predictor of the COVID-19 sell-off. And subsequently, they've come right back in line with equity markets in the United States having rallied. They're currently below the median value, meaning that things are back to normal within the credit spreads amongst banks. Another key theme is the consumer sentiment in the United States. Now, towards the right, you can see from the years of 2010, 2011, towards the end of 2019, there was an extreme rally in consumer sentiment. That was through the Trump era, if you want to call it that, the first 4 years of his presidency. So in general, he was a very stimulative president. He did tend to be a more rightward-leaning capitalist president, and that reflected within the United States. What's interesting, though, is how sharply that dropped off from almost all-time highs as soon as COVID-19 came out. And it's the sharpest drop we've seen on record, a lot sharper than during the global financial crisis. That has since rebounded, but it's nowhere near the levels that it was pre-COVID-19. And I think that's also analogous with the US election campaign. Trump perhaps had a chance, and that chance was largely eliminated because of this exogenous event of COVID-19. So it certainly has been an interesting year. And another point to make is we've had this massive stimulus by the US Fed, and the question is whether that's been effective. So Jerome Powell, the chairman of the Fed, has come out openly in saying that the US monetary policy is not enough to stimulate the economy. It's enough to prop the economy up, but it will not necessarily encourage growth. What they need for growth is a strong fiscal policy. And that, I think, is best shown through this chart, which shows the money supply, which is essentially the Fed throwing money at the problem, and then the velocity of money, which is how effective that process of throwing money at the problem has been. And you can see that the effectiveness drops off quite drastically towards the far right. So you can basically no longer throw money at the problem to the same extent that you used to be able to do. So just expanding on our view of global equities, we also have European equities within the portfolio. What we see here in difference to the United States is that we have a moderate underweight within this asset class. So the picture is marginally more negative for the European Union. That's predominantly based on value signals, which are at near all-time lows. So there have been, and that's been for quite some time, a suppressed value case for European equities. At the same time, we've got a neutral for the economic conditions, a positive for financial conditions. Again, that goes back to a stimulative monetary policy and also funding pressures and cross-currency basis. But the difference to the United States is that in Europe, business and consumer sentiment is also at near all-time lows. So what that means is that your citizens, as well as your companies, just don't back the future. And I think that's in part because of Britain's pending exit from the European Union, questions over whether the European Union will exist in the future. I think this is a very powerful chart to show that value case. This is the PE ratio of European Union stocks on the Eurostoxx 50. And that's sitting at near 40 times PE ratio, which is near all-time highs. This is a smaller sample set, but it's near all-time highs. And it's just not sustainable for the equity markets in the European Union unless we have significant growth to back up those valuations. So talking a bit further out, back to the macroeconomic side, the inflation, do we expect it to be lower for longer, or do we think that there is a chance of inflation, both in the United States and locally in South Africa? Well, in the United States, we had a very interesting story going through this COVID-19 sell-off. We saw the Fed aggressively cutting rates, which basically meant that the market's perception of whether the inflation target could be reached dropped right off. That's proxied by the red line, which is the 30-year inflation swap. On the far right, it drops right down to around 1.2, 1.3%. That versus the Fed's long-term target of 2%, implying that the markets thought that it's now no longer possible for the Fed to hit that target in the long run. Jerome Powell then came out and he said that the Fed is changing to an inflation averaging approach, which means that they no longer specifically target 2%, but now they target 2% on average over the long run. So what that implies is that inflation in the United States can run above 2% for a considerable amount of time. Almost immediately, inflation expectations picked up right back to that 2% line. So for us, inflation is now a valid point. We think that it is going to stay at around 2%, so our assumptions remain unchanged. A very quick analogy on that. So this is the US inflation versus oil futures. So of course, it's a very oil-based economy. What this shows is that if oil prices do not change at all over the coming year, we would expect US CPI to drift back to the 2% range. Bringing it back onshore to South African and the Reserve Bank's inflation targeting, what we saw was a slightly different picture. Now, year-on-year inflation within South Africa did drop below that 3% band. It's since reverted to the lower end of that 3% band, but the market perceived that as not a sustainable outcome. So from the very start, the market saw via that 30-year inflation swap that inflation was in fact going to be higher than that upper band of 6%. So it was initially a very different story to the United States. They've now almost converged. And in essence, what we're saying is that our view is that inflation is certainly here to stay at policy rates. An interesting way of looking at that is whether the Reserve Bank has essentially been engaging in quantitative easing. And this is an interesting one because it shows the M3 money supply, which is the broader money supply, which includes Reserve Bank, and it shows how that did expand coming through this crisis. So essentially there was implied monetary stimulus from the Reserve Bank, but the other three, or certainly the green line, private sector credit extension, did not increase in line with that, implying that the banks either aren't lending or businesses and consumers aren't borrowing, in spite of the reduction in interest rates from the SARB. So that's quite an interesting one for us. Whether they converge over the long run is something that we will be looking at in detail. So with that, I'm going to hand back to Bastian to cover whether the impact on asset classes from lower interest rates is something that's important for our balance process.
Thanks, Rupert. Yeah, important theme which we're going to showcase now is that Rupert made a strong case why inflation in South Africa is going to not be lower, so it's going to revert back to the upper end of the SARB's target. And same point in time, inflation swaps in the States are also pricing back to above 2%. So we're not going to see inflation which is significantly lower than what we've seen over the last couple of years. Yes, inflation was low already, but we don't think it's going to be lower or stay at that level. We think that it's going to revert back to its long-term mean, 2% roughly in the States and almost 6%, including an inflation risk premium in South Africa. And the bad news for investors really is that we do think, though, that interest rates in turn will stay low. So that's a big challenge, because what it means and what it implies is that the real return on cash and the real return on fixed income assets in general is just going to be lower. We can see it already now if you look 1 year out and you just compare the 1 year interest rate swap to the 1 year inflation expectation. You are already in South Africa in an environment of negative real rates. So putting your money in the bank account is definitely far more problematic going forward than it has ever been over the last 10 or 20 years. So we once again reverting back to the global environment, and what we are showing on this chart is basically just different expectations and different measures of the real return of cash. Just looking at the blue flat line, this is our forward-looking expected real return of cash in the States, which we've moved down to 0.3%. We've also moved it down to 0.3% in South Africa. So we do think that putting your money in the bank account will not give you more than 0.3% more than inflation over the long term going forward, while historically we have seen that real return of cash between 1 and 2%. So that's just, in my opinion, the best description of the challenges ahead. It is going to be tougher, especially once one retreats to the haven asset classes. We're also showing in the red line the Laubach natural real rate. So this is a model from Thomas Laubach and John Williams, who basically estimate their version of real interest rates, or where the real interest rates should sit right now to be neutral from a monetary policy point of view. And you can see that this red line also drops straight down to 0. So they are quite in line with us. According to their analysis, real interest rates are actually even going to be lower. So that's very concerning. The gray line is what we could really earn on cash in the United States if you put your money in the bank account. And you can see already that over the last couple of years, we already had a significant negative real return of cash, because there was a prolonged period of 0 interest rates, but inflation has never gone to 0 in the United States. It has always stayed below 2%, but actually close to 2%. And that's why we see this consistently negative 2% real return, negative real return of cash. Some theme which now clearly expands into emerging market. This slide is just a quick summary of our long-term return expectations. Everything I just mentioned features here. That's why we decided we would show it again. So this is our 30-year asset class outlook. Very, very long-term, but it is just so important to get these numbers right to derive your strategic asset allocation. The blue area on the very left-hand side of all those bars is our inflation expectation for the United States. Again, 2%. Then we've got the long-term rate differential, which is 4%. So we do think that in South Africa, inflation, including an inflation risk premium, should be at roughly 6%. And then you can see the small blue bucket, which is just 0.3 now, which is the reduced real return of cash. Okay, then we've adjusted some risk premia as well. We've adjusted the risk premia for emerging market bonds. We do think emerging market bonds in general are going to be more attractive, because given the poor fiscal situation, which some of the fiscal challenges, at least, which quite a few of these emerging economies, including South Africa, obviously, face, we have seen a quite drastic adjustment already in market pricing, which gives a very elevated risk premium for the foreseeable future. And we've reduced the, call it equity risk premium, or the earnings yield, which is the inversion of the PE ratio. So we do think that even in equities, returns are going to be lower going forward. So just to give you an idea, we've reduced that earnings yield going forward from 6% previously to 5.5% for the developed world. And then we would feed this earnings yield through to emerging markets and just overlay an emerging market risk premium. So long story short, inflation back to normal levels, but a lot of reasons why one should expect lower returns, not just on fixed income assets, but also on maybe even equities over the long term, but predominantly on all the safe haven assets, where we are concerned that the ability of them to beat inflation will continue to be eroded. This slide, we're just going to jump more out of the short-term picture out of the long-term picture, more into the short-term picture. This is basically just a summary of the asset classes and our views, which we are taking in the fund. So we have moved from a more negative picture on US equities, which we turned into when we saw new all-time highs on the back of still quite poor economics. We are moving to a more neutral view now. The reason for that is, as Rupert highlighted already, very easy monetary policy, which we saw earlier, but now also an improved sentiment. Okay, so We don't think this is the start of a new bull market. For that, valuations are just too stretched, and the economic cycle is not in the right space either. But we do think that a more neutral stance is warranted because, let's call it, the fear or the shock of COVID-19 is starting to recede, and we are seeing business confidence, which is on the path to recovery. Where we are more positive is mostly emerging market bonds. I mentioned that for the long term when I spoke to the elevated risk premium, but also on the short term, we really like South African government bonds and emerging market government bonds in general. The driver behind that would mostly be valuations. So yes, we are very concerned about the fiscal situation in these markets and especially in South Africa, but we do think that a lot of these risks are already in the price, and we can see CPI plus 7, CPI plus 9, depending on which point of the curve you pick. So that is extremely attractive from a valuation point of view for bonds. Credit mostly positive. We've seen credit spreads tighten again aggressively, but they are not all that tight yet, so there's still a little bit of risk premium in there. And then on real assets, those are the asset classes which we actually almost like most. So listed property is again a steep value case, a lot of economic concerns, a lot of concerns about the sentiment in South Africa, which will lead to prolonged periods of vacancies. So we are well aware of these problems. Having said that, we do think that the combination of very cheap valuations and low interest rates are very positive for this asset class. And if you look at preference shares and ILBs, again, overweights mostly driven by the strong valuations. So preference shares, the spread against JIBAR is close to an all-time high. And for inflation-linked bonds, if we go to the back end of the curve, we can still lock in real yields in excess of 4.5%. So those are the asset classes we like. You will see at the bottom of the chart the South African rand, where we also have a moderate overweight. So we also like this asset class on the margin. Again, similar to bonds, we do think that the currency is significantly undervalued. We also like the interest rate differential, which might might come as a surprise, because at the front end, the interest rate differential between the South African rand and the US dollar has actually tightened because we cut interest rates more aggressively than the United States. Having said that, if we look further out the curve, the interest rate differential has widened dramatically, and we must also keep in mind that the inflation differential has also tightened significantly. So all in all, we are positive on the South African rand at these levels. If we look at the Prescient Balance Fund, you will see that there are currently no tactical asset allocation tilts, simply because we have moved away from the strong underweights and the strong overweights, and we would mostly reflect only those tilts in our Prescient Balance Fund. We do reflect all the tilts in our basically absolute range funds. Okay, so moving back to the Prescient Balanced Fund, this is our asset allocation. We are basically stuck straight on our strategic asset allocation because we don't have strong underweights or strong overweights in place right now. We are structurally a little bit lighter on South African equities than most of our peers, just with 40% allocation, slightly heavier on listed property, which is a 5% allocation, 9% property, 3% ILBs. We are very serious about ESG, although we don't like the idea of sacrificing returns for ESG, but we don't think that this is a necessity at all. So we do use within our alternatives bucket our own in-house renewable energy fund, which is a great uncorrelated asset class, which we once again access at 0 fees, and it still has a quite high, other than having a positive impact, it also has significantly higher than cash real return expectation. We've got 3% prefs, 5% South African high yield corporate bonds, and then in the offshore space, that's where the fund is structured quite aggressively towards equities, so 18% developed market equities and 7% emerging market equities, so 25% equity allocation offshore, which obviously has helped to outperform over the last couple of months. If you look at the currency hedge, we've got a 5% hedge strategically, we have a strong conviction of an underweight or an overweight of the rand, we would add or reduce to this currency hedge. At the moment, we've got 30% offshore and 25% of that offshore allocation is hedged back. Sorry, 5% is hedged back into rands, 25% is dollar denominated. Okay, so that's basically the fund in a nutshell. We have one last slide in our presentation where we want to quickly reflect on a systematic approach during a period of crisis, and we are quite happy to say that we are being reassured that the data-driven systematic approach which we apply has fared well through the crisis, and that we have weathered these stormy waters quite well, I think. We can say that what helped us a lot is that this systematic approach is obviously free from human biases. So we are all human beings. We're all driven by human biases, and fear and greed both are not good supporters when it comes to your investment decision making. So if you are free from human biases, which we can be by just cutting through the noise and looking at the data, you are able to make more informed investment decisions. We have a stable and predictable outcomes relative to our peers. So that's driven by the fact that we don't stock pick. So we are very convinced that our portable alpha process is just the way forward for equities. So on top of our equity building block, on top of our property building block, on top of our offshore building block, we are able to port fixed income alpha, which is just far more reliable and more stable. So we avoid the outliers and we avoid picking the losers. And that's what Maya has shown in the intro, that gives us a stability of a fund, which even over a very short-term period, like just 1 year, is in the first or second quartile more than 90% of the time. That leads me to point 3, outperformance of peers, slowly but steadily. Measure tilts. So yes, we did a couple of TAA tilts during COVID-19, and no, they have not been additive, but all our tilts are measured, and the fact that our strategic asset allocation is designed, as I think, in a quite smart way, we were able to basically stay in the second quartile on a 1 year basis rolling throughout the crash, throughout the recovery. We've never dropped out, and at the same point in time we managed to stay in the first quartile. Over 3 years, over 5 years, we've never dropped out. So that's encouraging for us. And lastly, and that's an important point, we have to speak about the scalability of every investment approach. And we at Prescient are convinced that with a smaller team, with a more cost-efficient, call it labor force, simply because we don't have to employ that many analysts, we are still able to process more data. So there's more than 1 million data points which are getting processed by us on a daily basis to lead to our investment decisions. And we just claim that this approach has an edge compared to a more traditional asset allocation approach. So lower fees, that's our last point. That is driven by the fact that, yes, we can run more efficiently, we can run with a slimmer team, and because of that, because of our strong belief that you have to keep your costs low, we are actually able to give those fees back to our investors, and we run the fund at just 30 bips management fee, which is pretty much in line with most of the pure passive products. So yeah, that's our presentation in a nutshell. We're going to open up for questions now. Thanks to everybody for listening, and yeah, if there's questions, please post them now.
Thank you, Bastian and Rupert. We've got a few questions here. The first one is probably reference to what I said as well. But just to the audience, if I can cast your minds back to a diagram we've showed many times depicting our investment process. It's a circle that starts with the strategic asset allocation, moves on to tactical asset allocation, portfolio construction, and implementation, and that kind of repeats. And in the middle of that is risk management, which is really the cornerstone of everything we do. Now, to be able to do risk management effectively, one needs to understand exactly where your returns are generated, and detailed attribution analysis forms the key component of that. So with that intro, the question is, I referred also to the three sources of alpha in an active approach, which is SAA, TA, and portable alpha. Bastian, which of these sources was the strongest contributor to your returns? Now, I imagine that would be, let's say, over the last 12 months.
Yeah, so over the last 12 months, or even on a year-to-date basis, most of the audience might be surprised, but it is really the optimized strategic asset allocation which has given us an edge. So we are slightly lower on equities. We hold asset classes like US Treasuries, which has helped a lot, and we hold alternative asset classes like our renewable energy fund, which really have stabilized returns. And that strategic asset allocation has continued to be a contributor and a positive contributor, obviously, to our returns over the last couple of months. And through COVID-19, our TA tilts weren't that correct. So we had a slightly negative contribution, but that was compensated for by our strategic asset allocation tilts and also by the stable locally generated portable alpha. So yeah, it's always a combination of these three drivers. So far, the strategic asset allocation, the optimized strategic asset allocation has continued to be the strongest driver of returns.
Okay, and just, that's relative to peers, no? Okay, just another question here. With interest rates remaining low and inflation expectations higher, and you referred to this negative real rates we expect going forward, do you see local and or offshore investors returning to SA growth assets where they've been absent for the last few years? And just to position that, we know that income funds has been extremely popular the last number of years. And do you expect this trend to change and us seeing more influx in growth assets and boosting equity returns?
Yeah, that's a very difficult question to answer. So we do think that once we get through COVID and through more normality, and we get to an environment where there is a little bit more certainty and clarity of the global investment outlook, we do think that emerging markets in general will benefit from this. So we would expect emerging market bonds to outperform because of spread compression. We would expect flows back into South Africa, yes. So we would clearly expect that also to strengthen the rand. Having said that, fixed income assets will, there's difficult times ahead for this asset class simply because the current level of interest rates being mostly fixed by the global central banks at such a low level. So yes, I do think that money can flow back into growth assets, and our asset allocation reflects that with a neutral stance. If we would see a significant turnaround in sentiment and a significant turnaround in the economic picture, then yes, we would expect equities to rally further. But one has to really also differentiate between regions, and we mentioned earlier that for the United States, as an example, and also for Europe, the recovery already has run its course.
Okay, another question here, extremely popular and relevant topic is around ESG, and especially globally. On the balanced fund or general in your process, do you consider yourselves to be ESG friendly?
Good question. Yes, it's a clear yes to that answer. So ESG is very important to us. We take it very seriously. We always put our investors first, but we really do think that ESG doesn't mean that one has to sacrifice returns. So the way it is reflected in our process is, as an example, in our credit process on the fixed income side, we do consider the ESG component. But within the balanced fund, we also explicitly have a 5% allocation to our own in-house renewable energy fund, which obviously is a very, very ESG-friendly investment.
Okay, thanks for that. It looks like there are no more questions. I'd like to thank all our listeners for attending. I'd like to thank the presenters for sharing their views. And I wish everyone a great rest of the day and a great week. Thank you very much.
Thank you.
Thank you very much.